Hi there. Just testing the sound. Can you guys hear me?
Yes.
Hi there. Cool. Our time is up now, so I'll start just quickly run through our deck. So by way of background, we started originally as a solution for alternative provision of kind of long-term savings and pensions equivalent savings product on chain. What we're working on right now, which represents a partial pivot, is a model that it is essentially a user-owned and user-governed pool of capital, so effectively a DAO that fulfills two main functions. One of them is issuance of credit to its members. I'll focus on that section in this presentation, and I'll talk through the rest after I'm done. So how do we approach the issue of uncollateralized loan issuance using a DAO framework, and why that matters? So our use case was essentially fairly straightforward. We wanted to experiment with a solution that would provide users with access to credit and high yield savings without dependency on the banking system. Historically, the core Guys, can you hear me now?
Yes, we can hear you, but no presentation. I can share my screen and I can share presentation, and you can...
Yeah, that'd be great if you don't mind, because I'm on the I'm on the screen share. 1 second. Did you see the start though? So it looks like it just suddenly dropped off.
It's dropped off at the phrase historically. It's like the first slide.
Cool. Yeah, listen, if you just... Sorry, guys. Okay, perfect. Cool. Thanks, Yana. All right, yeah. Let's... So this is the last slide that you saw?
Yes.
All right. Okay, wow. Okay, cool. Just give me a second. Okay, let's move to the next slide. Cool. So I'll retrace myself. Sorry about that. So essentially, the focus of our approach was to ensure a focus service to the members of the DAO. The DAO will have a legal personality to be able to legally own physical assets and enforce the legal rights. What we wanted to ensure is that we have a right balance of kind of simplicity, efficiency, and being able to iterate and upgrade, in order to ensure there's credit issuance to the members as well as access to high yield investment products through the DAO. Right now, what we have is enabled undercollateralized lending. We incentivize early adopters using modern curve mechanic, and we're integrating fiat of non-ramps, and of course the contributions into the treasury are immediately put into interest generating products from the DeFi space. Next slide, please. This is what a user sees when they when enter a pool. Essentially, there's an evolution of the pool size. There's access to my loans sections and my guarantees. So essentially, what we're talking about here, what we're showing here rather, is in exactly the same way as rotating saving societies work, but here in a sort of on-chain, more pragmatic fashion, a user can request a loan, or it can act as a co-signer of the loan, as a guarantor for other members, and have an increased participation in the interest rate income, obviously, from that. Next slide. Thanks. Yeah, we can skip through that. Next. Right, okay. Main issues behind solving for this use case are twofold. There's on-chain risk assessment and a liquidity provision, liquidity management, rather, what we refer to as cash gap. As far as the on-chain risk assessment is concerned, the most, let's say, straightforward way to tackle this is to enable staking through the members based on one's off-chain reputation, which is what we've implemented in this version. However, what we also look at, and that's for the recent integrations with off-chain credit score providers. We're thinking through the implications of these trade-offs right now, but that will enable much greater scalability. What we want to make sure is that the privacy trade-offs are appropriately considered. As far as the cash liquidity is concerned, the cash gap or lack of liquidity is concerned, we designed the DAO treasury to be programmatically governed as a function of liquidity preference of its members. The allocation between, let's say, DeFi assets, let's say DeFi interest-bearing assets that have immediate liquidity, and off-chain assets that require a fixed-term commitment. These are the inputs that ultimately define the haircut applied to effectively use this net asset value when and if they wish to exit the pool. Next slide, please. Yeah, next slide. I've covered this already. Yeah, next. We talked about this. I'm just mindful of the time. Cool. That's a pretty straightforward slide, right? So since we used token blending curve, obviously constructed P token that we use that's abstracted from the user experience that serves to programmatically provide incentives in the following scenarios. A user joins the pool when liquidity is low and therefore is entitled to a higher proportion of the profit share of the pool. User leaves the pool when liquidity is high. User can take a loan when liquidity is low and repay a loan when liquidity is high as a function of total amount of funds, or let's say AUM equivalent in quotation marks in the DAO. The shape of the curve is designed to attract as many early adopters as possible. Next slide, please. Great. Loan issuance is based on a community collateral model. This is current implementation. It's currently being, let's say, revised / debated internally with our kind of support group and group of advisors, and very welcome to hear more views around that. If anybody wants to discuss it, just feel free to ping the team, myself or Yana. The current implementation mimics the way existing community banks and rotating societies work, insofar as borrower has to provide at least a portion of the collateral, in our case 50%. However, the existing DAO members have to effectively what is in mid-space called cosigning the loan, right? So they have to vouch for this member, which is reflected in staking, and it obviously entitles them to the interest rate income from that loan. It's an established market practice. It does have its own challenges in a pure on-chain implementation in the internet space, simply because we don't, unless every DAO members are known to each other, either very well or vaguely, in the absence of really robust solution for reputation, this approach can work it can certainly work within the Dunbar number limitations, and it can certainly work for small DAOs where the membership is active and people know each other reasonably well. It does have a natural ceiling to scalability, and hence I mentioned earlier that we're looking at centralized providers of credit data. We can talk about it later. Next slide, please. Here's a snapshot of a pool. Essentially, members propose to either support a loan or they ask for a loan. Fairly self-explanatory slide. how do we approach interest rate sharing and APR calculation? So, fairly straightforward approach. A borrower sets up an APR he or she is willing to provide for the loan. That's resolved through either acceptance or rejection of the proposal. It can also be handled as an auction. Pool receives 50% of APR provided by the borrower and redistributed between the members immediately. We incentivize voting through the economics of the interest rate distribution. If the borrower doesn't pay the loan back, the pool tokens take the loan are effectively slashed. So from that perspective, from the perspective of the pool, it is a fully collateralized loan. From the perspective of the borrower, it's an under-collateralized loan. As I mentioned before, risk assessment and enforcement is something that we are still thinking through. Are there better solutions? Yes, absolutely. We'll be working with a closed beta group to test them and see how we can strike the balance between simplicity and effectiveness. Next step, please. Cool. Bringing free from DAO's existing models, the problems versus macro solution. We're mindful, obviously, observing what's happening in the ecosystem. We're mindful of the fact that members might disagree with decisions made by the DAO, might not be able to leave it. So rage quit, not to is important, right? So it's important to be able to leave, take away your available balance, clearly as a function of how the treasury of the DAO is allocated. That balance will not necessarily be immediately available. If the treasury is fully allocated into DeFi interest-bearing products, then yes, there will be a maximum available balance that one can walk away with. If, however, the treasury is allocated into a combination of DeFi products and off-chain products, which is what we're working on, then the term profile and the liquidity profile are going to be different. It will be more restrictive, but frankly, if you can lock your money for a few weeks or months and get a much more attractive interest rate with a lower level of risk, a lot of people would do that. So whilst we have enabled rage quit, we also want to make sure that we give our users as much information as possible, and to this end, what we show at any moment in time is any haircut. So basically their cost of exit at any moment in time. That's calculated programmatically. If a user wants to leave the DAO and the borrower has not yet repaid the outstanding loan, your stake stays in the DAO until the loan is repaid. We're still iterating on those incentives. We're still iterating on how we can make the pool more efficient and more resilient. So that will be out in our further updates, and that's something that we're discussing with our beta testers and our advisors right now. Next slide. Cool. Potential edge cases. A lending pool has several edge cases at the moment when participants may be at a disadvantage, right? We have already seen over the last 2 weeks that a more complex a DeFi product is, a more potentially ruinous the consequences of either an executed attack or an exploit can be. We've identified 2 edge cases that we're currently are pondering on. Number one, let's suppose that we have Reminder for those that just joined, our P token price is defined by the shape of the bonding curve at any moment in time. If they all live at the same time, P token price will essentially dump, leaving other pool members at a substantial disadvantage. Why? You've got low liquidity, you've got low price. The solution would be to add withdrawal limits in order to maintain a pool in a relative state of balance, as well as deposit limits. For example, to increase the chance of a couple of whales influencing the pool excessively. That is not dissimilar to actually what is historically provided by the regulator in the security space. For us, it was a natural approach that would ensure that the pool cannot be easily gamed, and to preempt a fast set of attack vectors. Another case is connected with staking. So when a pool member stakes for the loan application, he or she, in fact, takes a part of liquidity, which programmatically lowers the P token price of the bonding curve. This design ensures that all P tokens are always backed by DAI, otherwise the pool may not have enough money for mass withdrawals. This case will be resolved at the UI level, and obviously there will be some off-chain involvement. We're thinking through how to address it programmatically, and we have a couple of ideas as well. So, again, if anybody wants to delve into the edge cases and attack vectors, super happy to have the chat and get input. We're discussing it internally right now. Next slide, please.
That's pretty much all.
Cool. So I think that's the last one.